Hello, friends, clients, and colleagues. Today is Friday, January 17th, and it's time for another 5 for 5 market update. This is Rich Siegel with ARQ Wealth Advisors.
This is Justin Rivera.
All right, Justin, let's get into it.
Alrighty.
Disclaimer, pause and read if you'd like. Okay. Okay, cool. First chart. This is a chart of 4 different benchmarks for 2024. As you can see, the big winner, S&P 500 in the green. And then we have some other laggards here. The Dow Jones up 15%, small caps up 11.5%, and foreign equities, you can see really took it on the chin for the last few months of the year, picking up the rear at 5.2%. A lot of that has to do, I would say, with the Trump election victory and then Jerome Powell's testimony on the last Fed meeting. Anything economically sensitive really got hit. Anything not strong U.S. dollar related got hit. The S&P turned in phenomenal returns, and 25% of the entire return of the S&P, 6% plus, came from one stock, NVIDIA. What do you think about
Yeah,
that, Justin?
that's that cannot be sustainable. Narrow
Right.
market leadership like that's gotta end at some point.
Right. Agreed. Top 10 stocks of the S&P now account for about 38% of the entire capitalization of the index, the most top heavy in history, including the tech bubble in 1999, 2000, and including the Nifty 50 back in a few decades earlier, the 70s and 80s. So, yeah, we don't believe that the top 10 stocks today will be the top 10 stocks 10 years from now. So
Yep.
let's move on to the next slide. Uh, this is the slide we put together to show kind of long and short-term perspective. Can you highlight the S&P 500 line there? Yep.
Right here. So this is the S&P 500 on this line.
All right. So look at 24 and 23, big returns, 25%, 26%, and the year before that, negative 18. 3-year average is 9, 10-year average is 13, and the 20-year average is 10. What do you notice about those, the far right column there? It's interesting,
Yeah,
isn't it?
yeah. It's kind of mean reverting to that 10% range, which is what an average annual return that we think of when we think of long-term stock market returns. We've had much better than that out of the S&P 500. Especially for the last 10 years, and it's definitely especially for the last 2 years. So coming back to that 10 range and getting
Mhm.
there, in the next couple of years is something that is on the table.
Agreed. I think what's really telling is the 13% return for 5 years. Most analysts feel, and you've heard these numbers in the journal and whatever on TV. Goldman Sachs, I think they said 3% for the next decade for the S&P.
Yep.
Vanguard's in the fours. JP Morgan's in the sixes. So we think the S&P will not be the big winner for the next 10 years. We think other areas will outperform, including small caps and foreign markets. Cash, the top row, far right, 1.5% for 20 years. Definitely not a long-term viable investment. The next line, bonds up 3%, really kind of crushed by the 22 return of negative 13. That was the worst performance in history for bonds. Today, bonds are yielding 4.5, 5.5, 6.5%. And the best predictor of future performance of bonds is the current yield. So we really think you're going to get nice returns in the bond market, 5 to 6% for the next decade. So super excited
Very
about the
nice.
opportunity to diversify and finally make some money in the bond market.
Yep. Absolutely. Alrighty,
Moving
next
on.
chart. Yep. Yeah, so this is a chart that shows kind of a technical aspect of how far we're into this bull market. So if you look on the bottom of this chart, you'll see that our bear market trough was on October 12th, 2022. And you can see to the far right, we're about a little over 2 years into this bull market. You can also see that the average of bull markets in the past has been 5.5 years. So although we've had
Mm,
some strong performance, and although it's lasted for a little while, it doesn't need to end here. There is a lot more runway, at least historically speaking, in typical bull markets. And that bear market, again, if we define that a bear market is a 20% correction in returns.
yep. I also like the fact that it shows the average return for a bull market is 192%, and we're sitting around 69%.
Yep.
Don't forget that bull markets don't go straight up from the bottom left to the top right. There are pullbacks, corrections in the middle of them. We think we'll have a correction sometime this year, lots of volatility, but we're not worried. We think the next few years should be pretty solid for the equity markets.
Yeah, that'll actually be a healthy thing, I think, for valuations moving forward. So,
Agreed.
yeah, great. Let's go to the
Absolutely.
next chart here, and that is kind of another technical aspect of where we are. Again, this here in the middle is showing that it's basically what happens after 25% declines in the market. These are all the instances in history, and we barely touched it in our
Hmm.
22 bear market. 1 year later, 22%. 2 years later, an average of 27%. When you can see
Yeah.
right below, the 2 year average is only 13% typically. And then it goes down to about 10% for 3 and 5 year returns. Um, Again, going back to we've had strong returns of these last 2 years. It's not uncommon for that to be the case, but a little uncommon that it's 27%.
Yeah, it seems like we're out of in front of our skis a little bit, out over the skis. I wouldn't be surprised to see some more muted returns, maybe a little pullback, bring the averages down a bit, and then kind of a nice reset to keep moving things forward in the right direction.
Yep. All right.
Hmm.
Last chart.
Last chart. Okay, great. This is just a very short-term chart we put together for just the first part of this year, January. And what you'll notice is just the opposite is happening so far this year. It's short-term, obviously, compared to what happened in the last couple of years. You see the orange line is the Nasdaq, barely positive for the year. The S&P is up 0.95. The big winners are value. Large cap value would be things like healthcare companies, big money center banks, JP Morgan, Morgan Stanley, et cetera, B of A. And then finally, SMID value, that's small mid value. Think about industrials, regional banks, utilities. It seems like the market has been broadening for the last couple of weeks. It's super exciting. And honestly, when everything's participating, it's a much healthier market, not just a handful of names.
Yeah, absolutely. I mean, nice to see at, over the course of 2 weeks. Would love to see
Hmm.
a lot more 2 week periods like this.
Right.
We'll need a lot more to get that valuation gap closed.
I think one of the things that really lend to a broadening continuation would be this new administration's policy positions around manufacturing and onshoring and reshoring of manufacturing,
Yep, absolutely.
and a strong dollar. So we'll see. We do like these names. A lot of stocks in the mid and small cap range are actually sitting at or below historical valuations, as opposed to these mega cap uh, companies we've been talking about forever that are trading well above historical valuations. So, yeah, more to come. We thank you very much for listening to the video today, and we hope you have a great long weekend. Speak to you soon.